He's in our technology companies group, and he's going to moderate the panel. We got a fabulous group of people, and he'll do the introductions. Thanks for coming today.
And as I like to say, Chad's a marketing guy, but you can still trust him. So thanks very much for coming. I really appreciate it. It's we got actually, I hate saying it because I sound like a stand-up comedian, which I'm absolutely not. We have a great crowd tonight. But thank you very much for joining us. Just a little, very short bit about Orrick and us here in Menlo Park in the Technology Companies Group. So Orrick is a 150-year-old law firm. We helped fund the Golden Gate Bridge and a whole bunch of other things that are almost completely irrelevant to startup companies. I'm part of the Technology Companies Group based here in Menlo Park, but we have folks spread all around the world, and that's part of our value proposition, which is we can take companies from Silicon Valley anywhere in the world, and vice versa. So that's my pitch to you, and I will say no more about Orrick because that's not why you're here. So I will invite our panelists to join, take their seats, and I may have missed it. We are, if Chad mentioned, we are short one panelist for a moment. Is Jacob here? All right, so I need you guys, I need your audience participation. When Jacob comes in, he's stuck in traffic. Everybody needs to boo when he walks in. Because you guys got here, you guys woke up early enough, you're here, we're here. But he's actually an old friend, so we hope he'll laugh. So I'm gonna let the panelists introduce themselves, and Gary's gonna do a little bit of a presentation as well about kind of the state of the market to help set the stage. But you'll notice this whiteboard here, which is not just so that you can get the Wi-Fi password, which I'm actually gonna erase, so if anybody needs the Wi-Fi password, you can grab it now. The way I like to run panels to try to make sure you guys hopefully stay awake is I'm going to go to you guys for questions first. After these guys do their introductions, I'm going to go to you to ask some of the questions that you'd like to hear the panelists discuss. You're not going to get the answers now. Over the next hour and 20 minutes or so, we'll use those to guide the conversation. So please, as you're listening to the introductions and the presentation, please think about your questions, and we'll take those and run from there. So I'll let everybody introduce themselves.
My name is Ron Will. Last 4 years I was at BrightRoll, which recently sold actually to Yahoo. Before that I was 7 years at Yahoo. Started out in acquisitions and worked my way into the Treasury group. And then, is this not on? Oh, there we go. Okay, thank you. And then before that, I was actually at banking for about 12 years. So I started in '89 at Lehman Brothers in the M&A department, and then I actually worked at Merrill Lynch out here for a bunch of years during the first bubble, I suppose I call it.
There are two.
Maybe more.
So I'm Aaron Crum. I run the corporate development effort at Yahoo. I've been at Yahoo for a couple of years now. Before that, I was actually corporate development at Google. Corporate development at a firm called Navtech. Before that, not a household name, but digital maps. If you use the map to get here, there's a good chance you use that data. Before that, banking. I was at Credit Suisse in the Chicago office. Navtech was actually one of our clients. And then an analyst at a smaller firm on the East Coast.
Gary Moon. I run the tech practice for a middle market investment bank called Headwaters. I actually went the other way. I started as an entrepreneur and switched over to the dark side about 14 years ago. And here I remain. But Headwaters has about 70 bankers. We do transactions in the kind of 25 to 250 range.
Villi Iltchev. I lead the corporate development team at Box, which is a recently public collaboration and file sharing company. I'm new to Box. Before that, I spent a year on the management team of a services and marketing company called LifeLock. Before that, I led the corp dev team at Salesforce, and I spent a little bit of time before that at HP. Basically leading the corp dev efforts for the networking business, Bulker at HP, and I started my career in the Valley as a banker at Merrill Lynch, I think a little bit after you had departed.
Great, thank you. I didn't realize the entire panel had banking backgrounds as well, so.
Does that mean we can limit the banker bashing today?
No, it means we can embrace it.
No.
You guys know better. Usually we hear the lawyer jokes, so it's only fair. That's fair. Gary, you've been kind enough to bring some of the materials that you guys have prepared, kind of the state of the market. You don't mind if...
Yeah, I'm nothing like warming up the crowd with some slides on the market. So I will make this brief. But the first one here, we like to break down the markets into distinct sizes. Certainly the tech M&A market broadly acts in a certain way, but we think each of these sub-markets has some distinct characteristics, so we track it a little separately. I think what you can see in the last 4 quarters is, pretty good volume and a pretty good market, but not outrageously so. So to the bubble question, I'm a firm believer we are not in another bubble, but that's perhaps interesting fodder for conversation later. This slide is we get asked a lot of questions about the window, the M&A window. Is it open? How long will it stay open? So these are kinds of materials we use to answer that question. This is we're in a good markets don't last forever slide. So that certainly should impact thinking about any transaction timing.
He did, nice. I heard that was coming, sorry.
Yeah, I just had to wait for that. And again, just another breakdown on size of market. Not surprisingly, sub 200 million is where most of the activity is. And then it drops pretty substantively in increments. And this is what I call the think about your post-money slide. Is there are those companies who are certainly going to go IPO or nothing, and the capital structure will look that way. There are a lot of companies that at the end of the day, the exit's going to be an acquisition. Not everybody's a 10x or greater return. Not everybody's going to achieve $1 billion valuation. And so sometimes we see a lot of mistakes in thinking in companies that are most likely going to be acquisition candidates and working with their post-money, setting it too high. When you get above 200 million, it starts to get a lot harder to get a deal done. So, and as a former engineer, I can geek out on M&A for a long time. But this is a similar slide. One of the questions that we had talked about was a dual process between IPO and M&A. I think what you see here, and not surprisingly, as you get between 500 million and $1 billion, most companies are planning to do an IPO. And so M&A drops off pretty precipitously until you get to about $1 billion in valuation when it starts to pick back up again. And a lot of those are companies that have gone public that ultimately get snapped up by the big guys. And then this one's just a correlation. Again, kind of the sub 200 million market is correlates the least with the public markets, and not surprisingly, the larger deals the most. So anyway, that's what I brought today. So happy to move on.
Thank you. As promised, I will turn to you guys. Otherwise, I have to ask them my questions, which I'll probably do anyway. But questions from the audience. I've been known to put ringers to avoid this. It's okay to raise your hand and ask a question. Otherwise, you do have to listen to my questions.
What are the variables that you look for in terms of a company that makes them a good acquisition candidate?
What makes companies good acquisition candidates? Others?
How can a venture fund find earlier about the interests of the strategic acquirers, like the roadmap?
Others?
Real quick on the
this business cycle that's inevitable, what will be the signs that you look for to see the indications that that's happening?
How much of a direct correlation is there really between taking money from corporate venture and subsequent acquisition?
What are some of the best ways to attract strategic investors early?
I'm interested in how they structure their groups to work with the rest of the business, maybe specifically around how do they source deals versus relying on the business to kind of source them and then they jump in.
The best way to get pricing is to have an auction, but typically the first acquisition approach to a smaller company is going to put a exclusivity clause or a confidentiality clause around it. How do you get an auction environment set up, or what's the banker idea for getting multiple prices on the table?
Others? This is a good list, and it's actually a lot of the things that we talked about in our pre-session call. So I'm going to start with kind of a general question, and there's nothing better than leading with a cliche, but are companies bought or are they sold? Discuss.
Yes. I think it's very situational. I mean, even though I'm in the selling business, we're often working with companies in advance of any kind of an engagement letter on this question in and of itself. We find that most acquisitions, people acquire people they know. And so there's a period of when you know acquisition activities on the horizon of getting to know a lot of the likely acquirers, whether it's business development, strategy, product. The more connectivity there is to some of the likely acquirers, then the more likely you are to get bought. And that being said, there are companies that you kind of start from a cold start basis, and you need to go out and canvass the market. So
Others are welcome to.
So we had this question when we started our company Exitround about 2 years ago, because we wanted to provide software that enabled buyers and sellers to connect more easily. And so we went out to some of the largest, most active venture firms in the Valley in New York, and actually all 25 of these firms contributed their actual exit data to us over the past 10 years. And so we have actual exit data from Y Combinator and Techstars, 500 Startups, Softtech, Sendena. And what we saw is that 88% of transactions actually happen under $100 million. And that's the segment that we focus in, so that's kind of what we're looking for. But what that tells me, and there's many conclusions can be drawn by that, but for us, the sub $100 million market is a place where you're potentially looking for an exit. It's where you get up above multi-$100 million, multi-billion dollars that the large acquirer comes in and is voraciously looking to acquire you. So that's kind of a data point that we look at. I don't know if there's agreements or like
I'll just add that, and I'll qualify my comments for technology, the technology space, because I think in other sectors the dynamics are slightly different. But in the Valley, companies are bought and sold, and I think if you're to generalize, I would say the high quality companies tend to be bought. They're not for sale usually. The VCs are not looking to get out of something that's working for them. And the companies that tend to get sold are things that potentially don't have the same upside as the VCs would like, and they try to exit earlier than they had planned.
So I guess what I would add is, it's an interesting question. Pick your cliche, right? An acquisition is a marriage, or however you want to think about it. But the simple truth is there's an element of both in almost every transaction. Now, sometimes a buyer forces a seller's hand, or forces the VC's hand to sort of exit. And so it's not. I'm not saying that it's not asymmetric, but there is an element of buy and sell in every transaction, of course. Anecdotally, so early in my career at Yahoo, we bought a company called Zobni. It was one of the first transactions that I did. Jeff Bonfort now runs our communications team. He likes to tell a story about how he was at Yahoo, and he was visiting Yahoo, and his Tesla ran out of juice, and so he was charging it in our garage, and he was waiting in our cafeteria, and he ran into Philo, and he pitched Philo, and that's how it happened. And of course, that's a great anecdote, and I love Bonfort, and I would never stop him from telling that story. It's really charming. But the simple truth is, we had met with him 4 times before. He was on a list that we were culling down and sort of listening, sitting there going, who's strong, who's stronger, what do they offer, who's the greatest fit, that is all happening in the background. So I love that anecdote. It makes me smile every time, but in part because in truth I know that we're also looking for a strong team, a strong technology, great fit with our product sets, those sorts of things. So it's a cliche, but the simple truth is that there's an element of both. It's not that it's not asymmetrical, but there's an element of both.
And we represented Zobni, so I couldn't possibly comment on the truth of any rule.
And I had talked to Jeff 12 times prior to that, in 2010, 11, 12.
Jacob, we skipped over you in introductions, and maybe I can ask you to introduce yourself. And because you guys focus on the sub $100 million deals, maybe you can define acqui-hire for me.
Sure, so I'm the CEO and founder of a company called Exitround. We're a private M&A network and intelligence software. So essentially, I used to be at a venture firm and kind of saw how M&A happened. And while these guys are great, it seemed like we could potentially bring more people to the table if they only knew about their opportunities there. And so through a confidential, anonymous marketplace, people are able to do that. And so, we kind of focus in that whole long tail of M&A from zero revenue, pre-product, running out of money, to revenues of around $50 million, and kind of proactively looking for an exit, either to corporate or a private equity buyer. So defining an acqui-hire, there's the out of money, no options acqui-hire, then there's a small and a boutique acquisition. And so, I think when people hear the word acqui-hire, it means that the company's running out of money, and either the investors or the founders want to land the company at a potential acquirer. But sometimes that's the case. Oftentimes that's not the case. Oftentimes, the founders or the investors are actually evaluating all the best options at the moment, and they're trying to figure out, should we go forward, should we raise an equity round, or raise another round, or should we take on debt onto the company, or should we continue to cut the burn and bootstrap, or is there a strategic fit where there's a great company, we have a mutual vision, and a lot of those are relationships built over time, like these guys said. They meet with founders many, many, many times before anything ever happens. And so those are the ones that we kind of categorize as boutique acquisitions or small acquisitions, which is actually where, if you haven't over-raised in a kind of institutional venture sense, you're actually going to be able to make a little bit of money. Your early investors can make a little money, the founders can make a little money, and it's actually a pretty good situation. And so I think we kind of look at them in a couple different ways. But
so, what makes a company a good acquisition candidate, other than forgetting to charge your Tesla? And I'll ask everybody, because it's both from a seller, buyer, and intermediary perspective.
Yeah, I think, I'd go back to the earlier question: are companies bought or sold? At BrightRoll, over the past couple of years, we knew we'd end up in this no man's land, was kind of our view. And we focused on building a independent, successful company. And whether that fits with an individual company's acquisition strategy or not is somewhat out of your control. And you kind of have what you have when people start knocking, right? And so, we at no point, went through a sale process. We went through IPO preparation. We constantly focused on making sure that from a financial perspective and strategic perspective, we had what we thought was made the right decisions for us at that time. And if that happens to fit with someone's acquisition strategy, so be it. There were a lot of things that we wanted to make sure were not kind of non-starters. If you go out and raise a tremendous round and you have VC backers that have unrealistic valuation expectations, you will not be a good acquisition candidate, right? So we had only raised $36 million, and we hadn't done a fundraising in years. We wanted to make sure that we had a strong financial profile. We wanted to make sure that we made strategic sense in the market. So there's these high-level boxes we wanted to make sure we checked, and that we built something that was a sustainable company once we passed that $100 million threshold. I joined, we had already had 100 employees. By the time now we have 450 employees. We were kind of out of that, hey, I hope this works mode. And we had been profitable for a bunch of years, and that happened to fit with Yahoo and what they were looking for on the financial side. And then on the strategic side, you obviously have to check all the boxes that happen to work at that moment in time for potential acquirers. So, I kind of look at it it depends on where you are in your life cycle, and you can't run a company. I'll speak for the folks in the audience that are at a startup. You can't run your company to be acquired. You have to run your company to build a successful company, and if that happens to match with anyone, then that's great. We hopefully have a CFO or a GC that's making sure you're not doing anything incredibly stupid from an acquisition standpoint, or external counsel. But we kept an eye on what was going on in the strategic acquisition market, right? LiveRail and DAP-TV, and but it was not what we discussed 80% of the time. What we discussed 100% of the time was building a successful business, and that happened to fit with Yahoo.
So obviously, Yahoo's had a history of sort of acquisitions up and down the scale throughout its history, but also most recently over the last couple of years in the Marissa era, if you are okay with that term. And Ron's point, he made the point of it depends on where you are in your life cycle, right? So, and any buckets are a little bit reductionist, but like if you're early stage, predominantly what I'm looking to do is sort of fill a talent need and potentially a technology need within sort of someone's product roadmap that I'm sort of aware of, right? And that is not to say that your product, we're going to be disrespectful to the product or the audience that you built or anything along those lines, but odds are like you're being thought of in that manner, right? And so we're interested in your team and how it could operate within our team and the sort of their interest in being in a large scale organization such as ourselves versus just like, hey, I'm a startup guy, like. And then there are, and the technology and how robust it is, or is it just kind of kludged together, hacked together, those sorts of things. Those are all really critical at the early stage, and the financial results in the audience and sort of your customer set are sort of less so, right? And as you grow up the maturation curve, with sort of BrightRoll probably being sort of way towards the end, with huge customer sets and huge audience and reaching a huge audience and sort of with their advertisements and a network that was really robust. Like, that is, of course, in the lead of all those things. And then, of course, underneath that, we want a strong technology and we want a strong team and strong financial results, which is probably a little higher. And then, somewhere in between is something where we want we really have a technical need. Right? We have a technical need that is not being filled or we've been sort of surpassed and we need to catch up, and that happens all the time and we're going to focus on that. And then the other thing I would add is like the Tumblr style, like that was, we were in video but not to the extent that BrightRoll did for us, and it was more of an O&O focus. But Tumblr was big in platform expanding, and then suddenly it's about audience and sort of where we can take that and how we can monetize. So, think of yourself, again, the buckets are a little reductionist, but if you think of that life cycle, that can be helpful to you.
Yeah, definitely agree with a lot of that. The one important point that I would make on not running the business to be acquired, completely agree. Our usual take there is you should be thinking about it, but it's probably not more than 4th or 5th on the list of things that you think about. There are some plenty of things you can do to make it difficult, but it certainly shouldn't be the North Star in how to run the business, because that's very easily discovered. For us, as you can imagine, we look at a lot of companies and try and figure out who to work with. As you get to later stage, I think one of the things that we focus a lot on is what we call asset scarcity. That's how unique you are, and that can be along a variety of different vectors. So market leadership is one. Do you represent a market leadership position that somebody can come in and want to get into this market? That's incredibly important for the kind of high strategic value exit that most people are looking for. Product, we look at it as when you present an opportunity to an acquirer, or one acquirer comes in and you want to go talk to a few more, what are the choices that acquirer has to do something similar to you? If there are no other choices, that's really good for valuation. If there are a lot of other choices, that's really bad for valuation. And so, if salability at all. So it's difficult to kind of dice a little more than that, because it is very sector driven and it's very stage driven, which is one of the things that makes tech so fun and unique, is you really do have to dig in on each market and each segment and where that segment is within a stage to help figure that out.
From the point of view of a startup entrepreneur, like, I want to sell my business down the line. I want to build a big business and have a yacht or whatever it is. Like, I think about this, and it's kind of like, well, that's a long ways off. So how do I start doing that? And I think it's pretty simple, and I haven't solved it, but this is how I think about it. And that's like, first, build a great team, like the most amazing team that I can find, and the smartest people around me. And along the way, sometimes you realize some of those team members aren't great, and so you have to kind of let them go and move on. And so building the great team, and if you have that great team, together you're going to be able to figure out how to build a great product, and you're going to be able to find that product market fit. And it's going to take a lot of work, and it's going to be a curvy road, but you'll get there. And then after you have that product, you're going to build a great business. And some businesses, that may be massive engagement through mobile apps. Some businesses may be revenue within advertising. But whatever that is, you kind of have it. And then an acquirer wants to come buy, and ideally they want to buy the business. That's best case scenario. If they don't want to buy the business, then maybe they'll want to buy the product, because it's phenomenal technology, great amount of users. And if they don't want to buy the product, then maybe they want to buy the team, because it's a great team. And so you kind of leave yourself with optionality in those three areas.
Yeah, the only thing I have to add is buyers acquire companies for different reasons. They may be trying to solve a problem. They may be looking for specific expertise in a certain area. They may be looking to enter a new market, an adjacency, or buy growth. Whatever the reason is, obviously, if it's about revenue and build a great company, and you don't need to worry about buyers, and if somebody knocks on your door, it's all great, it's upside. There's certainly things you can do to make your life a lot harder to get acquired. You can be overcapitalized, which makes getting deals done difficult, as that was already mentioned. People take shortcuts with development. They offshore or outsource some key IP or development, and they're not building that team that you want to acquire. And so, if you, most buyers in the Valley are very focused on keeping people together, in the valley. So it makes it hard to acquire companies when half of the team is in areas where you don't have a presence. So keeping the team tight and together, and not outsourcing a lot of your key IP or developmental talent. Those are the smallest things you can probably do to ensure that even if things go wrong, you've developed something that somebody will find value in.
Gary and Jacob will ask you guys these questions separately because you fulfill similar functions but in very different ways. When does it make sense to get a banker or some sort of an intermediary involved in the process? And we say the process. What is the process? Capital P.
So it's a great question. Always would be the self-serving answer, but I won't actually get that one. No, I think there are different ways to do banking, and I'll be curious to hear the alternative here. Where we play in the market is what I call high touch, and that is the ultimate success of the acquisition is going to have a lot to do with how well you penetrate the organization, how well you help the company position, how competitive you can make the process, where guys with gray hair and a lot of deal experience will actually make a difference to the deal. Because most of my colleagues and I would have a lot of choices in where to work. We work in kind of 250 and below because that's where we think we have the most value. Because companies don't really have the function of what we do built internally, so we can come in and be that expertise, roll up our sleeves, work alongside the management team, and really help them get an outcome. What is the process? There are many different ways to do a process. I would say the process we like the most is when there's some engaged, active buyer interest. And you can leverage that to get out to the market and speak quickly to other buyers. At some level, you're canvassing a list of buyers, and that can be as short as 10, and we don't like these, but it can be as many as 100 or 150. At some point, you're pushing people through a formalized diligence process where you're presenting everyone who's interested with a similar set of information. There's a stage when you're calling the question, and that is, are you interested? If you're interested, formalize it in a letter and tell us what that interest is. Then you're negotiating with those interested parties, usually to pick one to go exclusive with and try and get through diligence to a close. So there are many deviations off of that, and then of course hopefully a close at the end.
And not to ask you your pricing strategy, but as a general matter for that type of deal, what's kind of the market for banker fees? In a broad range.
Yeah, so list price is 3% at 50, 2% at 100, and then it kind of graduates. But I would also say almost every one of our fee agreements is unique. There's oftentimes, if we agree your company's worth $100 million, we'll make okay money up until 80 million. We'll make the market at 100, and above 120, then the fee gets really interesting. We call that the aligned incentives approach. Not every deal is a good fit for that, but some are. If you really want somebody stretching for value, that's a good way to do it. The downside is you really stretch for value. So.
Awesome. So I would agree with Gary, the answer being always. We kind of see ourselves as very super complementary to what Gary's business does, and we come at it from a software approach, and software is replicatable by nature, and that's how we have to make it. And so we focus on bringing more people to the table, and kind of filling the top of the pipeline of buyers to the table. So in that sense, groups like David Cohen at Techstars or Tim McClure at 500 often tell their companies, hey, as soon as you raise money from us, why not build an anonymous profile on Exitround? It's a great way of identifying what buyers may be interested in you now or in the future. And one of the things that I think everybody here will tell you is that successful M&A happens after long relationships are built. There's a lot of trust. There's a lot of kind of belief in what you can do together. And so we see ourselves as being able to help kind of build those relationships earlier on. Sometimes it turns into M&A. Sometimes that interest helps catalyze a further fundraise. Sometimes it turns into a business development relationship. Sometimes it turns into strategic or corporate venture capital. You don't know, but at least now you're kind of getting exposure to who those buyers are that are interested in you. So from our perspective, so that's kind of the point of view. Our process is very simple. It's building an anonymous profile. It's characteristics of the entire company, but without your names or any identifiable information. We have algorithmic recommendation technology that identifies buyers who are interested in the space and recommends to those buyers that they should come talk to you. And those buyers may request to connect with you, and you can approve or decline that. So at that point, once you're connected with a buyer, we actually step out from that process. And to echo Gary, having a human there actually working with you on the process is incredibly important. And that is you as a CEO, that may be your investors, that may be an attorney, that may be Gary, but having someone there who's helping that deal push along and help build competitions deals is a huge important piece. So we see ourselves as kind of adding fuel to the fire. We're working with bankers to bring more buyers to the table.
Ron, did you use a banker for your deal?
We did.
I won't ask you to name them, but...
We did use a banker. We went through a similar thought process. At the amount we were at, it was pretty important for us to have a realistic view of the capital markets as well as the M&A market. And that's where we thought, particularly helping the board think through that. Should we go the IPO path? Should we consider a strategic offer that a banker came in helpful? We were a little different than a smaller company in that we had a pretty fleshed out management team that had some experience in this. We had great counsel. We had a pretty good sense of some of those things. We had spent some time doing a non-deal roadshow. We had kind of gone down that path a fair bit, but we thought that it would be helpful. It would increase the likelihood of success was the way we thought about it. And we didn't think that there was going to be something that would dramatically change, but if it changes the likelihood of something happening from 40 to 50%, then that pays for itself. And we had a relationship with an investment bank, and we spent a fair bit of time negotiating a term engagement letter with them, and I recommend you do that. It is all negotiable, and go from there. I would say that the bank that you work with over the early stages of your company's life cycle may not be the right bank at a different stage. Right? There may just be a different skill set that you're looking for, different relationships that you may want to have, different doors you want to get into, and that size criteria. So finding someone that has expertise in, let's say, the $250 million range versus a different size range, and just being realistic about that. If you get one of the bulge bracket firms, and they may not be the right firm for you if you're gonna do a smaller trade. And you have to be realistic about the dollar amount. Don't mistake the dollar amount likelihood with the investment bank. And the high touch model, I would also say, I would spend a little bit of time thinking about that as well. It is a long process with a lot of detail, and you may or may not have those resources in-house to fill that role. So you want to kind of think through that early on about what kind of level of support you're going to have. Like as I had a fairly large team under me, but the deal team is tiny. And so, because you can't share this with once you share it, they become somewhat tainted, right? That we might sell the company. And so, it's a very small team doing a day job, and then every night working till whatever hour. And you may need a bank to kind of fill that role of due diligence, and valuation, board communication, board materials, you name it. And so, you need to think through all that. You need to think through that very quickly. You can't kind of decide that when the term sheet shows up. So that's more food for thought.
And Aaron and Villi, when you guys hear that there's a banker involved, is the reaction, oh God, or thank God, or depends?
I think it depends. I remember getting in front of the board and saying, if we buy a company that came to us through a process, you should fire me. And I actually believe that, because my job is to build those relationships with companies that are important and strategic to us, before there is a process. So that kind of tells you my view of processes. If you know, and I said at the beginning, which is, if it comes to a process, chances are it's not a very good company. So, well, I'll probably engage. I actually, to date, not that I never will, but to date, I've never acquired a company that came through a process. So, I think that doesn't mean you shouldn't hire an advisor. You absolutely should consider hiring an advisor. And oftentimes, I would love you to hire an advisor because I find that the advisor actually works for me more so than for you, because they're very incented to get a deal done. And they can actually provide, especially with less experienced board members or management teams who haven't seen how this works, they can provide some support and context and bring some, you know, just make the process easier and for everybody. So, you know, advisors have a role, an important role. You know, that's not to say that auctions don't work. Certainly the larger the company, the more likely it is that it will be sold through some sort of a competitive process. But at the early stage companies, I tell founders that all else equal, including price, if Box is not the company you want to end up with, I don't want to do this deal. I don't want you coming to Box because I paid the highest price. Because at that stage, it's so much about the people, so much about making sure that they end up in a place and environment where they're going to be happy and successful for a long period of time. Otherwise, they'll leave in a year and you ended up not really achieving your goals.
I think I just heard a challenge that he needs to buy a company that's run through a process, so I'll take that. Okay.
So, I agree with the opening answer, which is it depends. My reaction oftentimes is, and in the case of BrightRoll, their bankers they did an excellent job, and they were a nice, strong, steady hand throughout that process. It was somebody that I have a relationship with, and so it was oftentimes a great way to sort of make sure that, you know, like there was to add to the level of trust that was already sort of hopefully growing between my team, our executives, and the BrightRoll executive squad. And they can do that. They can serve that quite well, right? Like, you know, there were times in our process where just like something came up, and it was great to have the banker be like, Aaron, you gotta sort of help me. What, you know, like the team is wondering what's going on, and I could say like, look, I can't tell you everything that's going on, but to suffice it to say, our appetite for this deal is unchanged, and that like, it was helpful to have that relationship in place and sort of the steadying hand on the, you know, on the steering wheel there. Not that, you know, we had any major sort of calamities come up, but it was just useful, and it made the deal more enjoyable, more useful, more probable, and so it was quite good. I've worked with a partner, I guess it is, at Headwaters, and in a process, I should add, for a company that I bought for Google, and they did an excellent job as well, in the sense that I didn't know Sun at the time, and now I do, and you know, but she was also that steady in hand, and she was very careful about, you know, like, she was very careful about sort of taking her read from the management team as to the posture that they wanted to take, that they want to go to war over every comma on every period in the definitive agreement. That's the case where I don't really wish that there was a banker involved, because I don't think we need to go to war over every comma and every period and every instance in the definitive agreement. But instead, she chose to, she picked her battles, and I could tell when it was important to the management team through her, and I could tell when, you know, and I could message what was important to me as the buyer through her as well, and so she did an excellent job in that sense too. You know, so it depends. If your banker is, or if your banker is going to run roughshod over you and going to pick battles that are unnecessary, and then it's going to add tension to the process and fundamentally add time and add and lower the probability of a deal. Or the opposite is better, obviously.
What's the role of the VCs in the process? Sometimes you'll hear board members, and we don't have a VC, so we can all pick on them. There may be some in the audience, sorry. You'll hear some VC say, oh, I can do this. I can be the advisor, I can serve the banker function, let's save the 3% or whatever. A, does that work? B, if you as a buyer, how do you guys work with the VCs, and as the intermediaries, how do you interact with the VCs who obviously have a completely different incentive set than the employees? And Ron, how I won't ask you for too many details, but how did it go with your VCs?
I'm happy to start.
Sure.
I think you touched on the incentives, and every board member has a different set of incentives, and you really have to make sure that there's some separation, depending on how early, depending on what valuation, depending on what structure, depending on the firm sometimes, and you really, I don't know if that would be the greatest of ideas. I think they have a very specific role in the process, and in our case, we set up a strategic committee so that we didn't have to call the whole board together to have discussion. That really helped. We did weekly update calls, we touched base. It was their responsibility to go talk to the rest of the board members. We had a fairly small board, but still over a half dozen members. So just the logistics of information dissemination during a process becomes somewhat yet another thing you have to do. As far as them jumping in on the process, they are an arm's length away from the operations of the company and beyond valuation and some of the high-level structural things. I don't know that they'd be the best person to be playing the same role that a banker would be able to play, nor do they have the same level of deal experience or granularity of deal experience that would be required for the process. So, at some point, you're still going to have, what is market for various things? What is important for the target for various things? And you get into details that, thankfully we had a general counsel. Thankfully, I was very operationally focused, so those details we could have a very quick response when Aaron or someone on Aaron's team would call and be like, listen, this just came up in diligence, and how should we think about it? That a board member's not going to have that level of familiarity there, and is also not going to take kindly to be talked over to by the CFO that has been effectively reporting to him for 4 years. And so it would create a weird dynamic, I think, during a process. And I think though we're one case, fairly large dollar amount, fairly specific acquirer. So I wouldn't. It's an anecdote, and I think there may be scenarios in the smaller cases where that's a great idea. Depending on the specific board member.
Yeah.
So, Silicon Valley is filled with amazing venture capitalists that do an excellent job and are very sort of pro company. And that's an important point that shouldn't be missed in all of this. The only thing I would say is, as a management team, it's also your job to understand what their role is, right? Like their job is to make money for the general partners, right? They believe, most of them believe deeply that sort of serial success and engaging with entrepreneurs and advising them through a process and not screwing them in the, and not leading them to a bad result is sort of the way to do that. That's how they believe in it, and that's good sort of philosophy. But I would say, to Ron's point, at some point, when there's time for the money to start getting passed around, you're going to, their natural incentive is there, and you need to understand it and make sure that you're willing and able to deal with it in the right way, and to it's your company, right, and be the management team that shepherds to the outcome that you want, right? And I would say, so if you're going to go without an advisor, you're going to let that VC sort of fill that role. That's your choice. But just understand that that's what you're dealing with. You're dealing with somebody who his role is to make money for his fund, right, and return it to his GPs. That's how he raises the next fund. And so, while he's not evil, he's not sitting there twisting his mustache, hoping for that last penny of return, that is what he does. And so understand that your outcome is not can be in some ways different than the outcome that that is ideal for him.
A few, just to add to that, a few interesting insights I've acquired over the years. First of all, the minute you engage with a buyer, you receive a term sheet, some formal indication, you now have two parties to negotiate with. You have to negotiate with the buyer, and you have to negotiate with your VCs. So the entrepreneur typically gets put in a very tough spot at that point, where they need to balance a lot of interests, including those of the employees too. So it gets tricky. The second thing that I often find interesting in M&A, especially with respect to how entrepreneurs and VCs look at deals, is oftentimes, especially with first-time founders, even second-time founders, the tolerance for risk between the entrepreneur and the VCs is vastly different. And so entrepreneurs, if they stand to make a few $1 million, maybe even more, 5, 10, that can be life-changing amount of money. It can change the life of your children and your grandchildren. There's, to geek out, there's this thing called the utility curve. It's an economic concept which basically says that your risk tolerance varies by how well off you are. And so the VCs are in the business of actually portfolio management, and they're happy to take risks because they can counterbalance those with other things. So the way I take advantage of that actually is oftentimes, if you align with the entrepreneur, they're actually willing to take a much lower price than oftentimes the VCs are willing to take. So, it's an interesting insight. It's not a secret. I'm not trying to make it a secret. It's just utility curve theory. Anyway.
Secret now.
And the last interesting VC dynamic that I would just observe is VCs can definitely play the role of introducing you to potential buyers, and they do, and they oftentimes do before they decide to engage in a formal advisor to conduct the process. What I find oftentimes really weird is when the VC actually takes the lead negotiating the deal. I find that to be actually very weird and counterproductive. So oftentimes those are either the extremely bigger than life type of VCs, or who think they can put their weight behind something and make it happen, or really unsophisticated VCs who this is one of their first exits.
Jacob, maybe I can start with you from the intermediary side. And in particular in smaller deals, one of the things that we see with very small deals, which are not necessarily home run, in a home run situation, there's enough money to spread around and everybody's happy. In the smaller deals, that's not necessarily the case. And so we not infrequently see transactions where there is this tension between the VCs and the founder team and the employees. And we see buyers, and some buyers do this more often than others. They will allocate kind of deal value from an aggregate concept and run it through employment arrangements and acceleration of equity processes. How does that process get managed, and that's where the rubber really meets the road in the negotiation between the VCs and when you have two parties? How do you see that process working when you have smaller transactions?
Yeah, so kind of the standard structure for an acqui-hire as we've seen it is kind of three components. One is some amount of cash, typically a smaller percentage of 100%, goes back to investors to try to get rid of them as soon as possible. Like, you want to get them out of the conversation. Because at the dynamics we're talking about, that can add a lot to it and cause deals to fall apart and all this kind of stuff. So the buyer is trying to identify through the CEO or the entrepreneur, what are your investors expecting back? Like, what's the expectation of your investors? And that entrepreneur may have different expectations based on how well the company's doing. So if you're profitable or you have a lot of money in the bank, then that expectation is far higher. If you're in a strapped situation, it may be lower. And so the buyer's trying to read what's that, the minimum expected return that we can give to your investors to kind of get them out of the conversation. you know, a lot of acqui-hire structures aren't structured as merger agreements. They're structured as asset purchases sometimes. Sometimes they're these releases of liability. You guys can speak a lot better to this than me. But essentially what it's trying to do is not actually touch the securities of the company, but kind of pay off the investors and then just deal directly with the employees and the team. So the first piece of the three we've seen is this kind of dollars back to the investors to get them off the table. And then the second is actually looking at each individual team member, evaluating them for their value in the transaction coming forward in the company, and then putting, offering an offer to them, kind of an employee offer. Sometimes there's a small premium to that as opposed to just coming in as a direct kind of hire. And then the third piece to that is a stay bonus or retention bonus. And so that is, hey, we bought you all as a team, we want you all to stick around. And so that's typically earnouts, or we don't see a lot of those, it's typically retention, so 3 to 4 years is incented there to keep butts in seats on each of those anniversaries. So that's kind of the structure piece that we see most often. But the one thing that I never fully appreciated is that M&A is the Wild West. Like there is no standards, ifs, ands, or buts about it. Like it is crazy. Whereas with venture capital and raising money, there's a market value, people talk, and you're within certain bands and certain types of structures. But within M&A, because the incentives are so deeply emotional for the founders, for the founders' families, for everything that goes on with that, as well as with the venture capitalists who are thinking about raising their next fund, as well as with the buyers who want to have great people and a great company to join theirs. Those deeply emotional connections tend to add to a lot of just different unique situations.
Notwithstanding the fact that I agree with you, it's the Wild West. That won't stop buyer, seller, bankers, lawyers from saying, this is market, damn it, this is market. So we've talked about the VCs, but we've focused principally on the Sand Hill Road sort of VC. There's also the element of corporate / strategic investors, whether it's a captive venture fund or just direct investment off balance sheet from a company. Obviously a very different dynamic. I'll start off by saying, and I'll turn to Villi and Aaron first. I don't know, you guys do some investment activity, but do you do it with the expectation that you want to be at the table from an acquisition perspective, or is it this is just interesting, we want to get to know as many companies as we can, and how does that correlate into ultimately potential M&A activity?
We've done a few investments at Box, but when I was at Salesforce, I actually led the investments program as well. And Salesforce has an incredibly active investments program. They have a portfolio of over 120 companies, and they include Box. So they include Dropbox and Evernote, and go to their website. They've invested in everybody. But the reasons for those investments vary, and they're not always for the purpose of potential acquisition. So admittedly, some of the investments are buying options on companies that you're not quite ready to acquire, or you may want to see how it plays out before you pull the trigger, but certainly you want to build that relationship, have a little bit of a leg up on somebody else. So there's this dynamic definitely playing, but it's not always the case. So, if you get approached by a strategic, just understand their motivation behind a potential investment. Nothing wrong with strategic investment, despite what the VCs in the Valley are going to tell you. Just what are you getting out of it? What's the point? Are you eyes wide open that they are doing it because they may want to acquire you, or are they doing it because they want to benefit from the value they're going to provide to you? So in the telecom space, for example, they may want to invest because they're going to purchase tens of millions of dollars worth of equipment or whatever from you, and they want to make sure that they have some control over some of their suppliers. So just make sure that you understand what they're trying to achieve with that investment.
Yeah.
So I would echo many of those comments from the strategic investment perspective. Yahoo right now is just we have a heavy negative bias towards investments right now, despite our pretty substantial success with some of the investments that we've made historically. And the notion there is quite clear, which is we have many things that we need to do with our business right now, and we need to focus on building that business by way of acquisition or normal sort of spend. So it's hard. We're not really sort of in the business of making investments right now. I also had a role in some of the investments that Google made. And I would say, my 2 cents would be I would echo the earlier comment, just know why they're doing it, right? A corporate investment can be perfectly legitimate and perfectly fine. Just be well advised as to what terms are being asked for, so that you can understand, the repercussions of those terms, right? So first refusal, options, those sorts of things are you'll just want to be well advised as to the implications of those terms. Oftentimes it's because the technology that you're looking at is you're about to build a substantial dependency on it, right? And it needs to be well funded, and it needs to head in a direction that you will need it to go, and that direction needs funding in order to pursue it. So you're willing to put capital at risk, and so understand kind of what they're after as it relates to that equity piece. Because if they're building a dependency, of course they have an interest and a desire to sort of protect it and make sure that it doesn't, this overstates it, but fall into the wrong hands or get it, get torn away from them at the 11th hour, or, right after they've gotten started. So just understand what they're after, and with that, I think I would say, you'll be fine. The investments can go actually quite well. I've seen them work quite well.
I think the only thing that I would add is be very, very careful about right of first refusal, anything like that. And the issue.
Be careful. Never do it.
Yeah, exactly.
Never do it.
Thank you. Because when it comes ultimately to your exit, that will put a very big chill on the market. Quite simply, people are busy. They have a lot of time to do, a lot of things to do, and nobody wants to set the market price for their competitor to buy. That's an awful lot of work for nothing. So I would agree, don't do it. Often there's a lot of negotiation around that. What we usually recommend is a notification right. That's completely appropriate. So it gets well negotiated, and I would encourage you to negotiate it well.
Ron, I'll make the mistake of asking a question I don't know the answer to. Did you guys take strategic investment, and if not?
We did. We thought about, I showed up in 2011 at BrightRoll, and we did a fundraising 6 months after I showed up. And we very consciously were not targeting strategic investors for a lot of the reasons. We had seen what had happened over the prior half dozen years with companies in the ed tech space in particular, with some pretty aggressive strategic investment that really, to the primary point, our company's bought or sold. Do you really want that sitting there and being a consideration for you? I mean, you want to build a successful business. Hopefully, you have a lot of options about where to get capital from, and structure of that investment is one of the considerations you're thinking about, as well as what other things may come along with that investment. So if you do think about a strategic investment, is it going to accelerate your business in some geographic region, or help with a key customer or a key supplier or a key buyer within the industry? That's great. But when you start getting into these structural considerations of like a ROFR, then you're gonna have a real issue down the road that is going to make it very difficult to get any kind of transaction done.
Villi, you were saying don't do it, so I'll pick on you for this question. But rights of first refusal, rights of first negotiation, rights of first offer. We talk about it in the M&A space. They're quite common, kind of understand what it means, although the details get negotiated heavily. Do you mind taking 60 seconds kind of describing what the broad categories of those rights that strategic investors may ask for in a company at the time of the investment?
mean, oftentimes the reason to make the investment is what Aaron described, which is heavy dependencies, especially in software. Nobody likes to license key part of what they offer to their customers, and they want to control it. And that's why you don't see a whole lot of third-party functionality incorporated into certainly enterprise apps. Usually companies tend to own and control their destiny. And so what I find is that, first of all, people that ask for rights of first refusal oftentimes don't know what they're asking for. They just, it sounds nice and good. If I'm going to make an investment, then I have the right to have the final say whether I want to acquire a company. But back to what I said earlier, which is I want to make sure that you want to be at the company that I'm representing is priority number one. I don't want to do a deal where the target doesn't want to end up being acquired by me. And because you're destroying a lot of value in doing that. So I often find that a notification right is a much more effective way of accomplishing the same goal. I want to know. The worst thing that can happen to me is for a transaction to happen without me having the opportunity to evaluate it, discuss it, consider it. And so all I want here is the opportunity to know if you're thinking about selling the company and have the opportunity to potentially give you an offer or have a conversation with you about joining forces.
Can I stop you for just a second on that particular point? Because one of the conversations that happens is, well, if I've got an offer from somebody, if someone other than my strategic investor is expressing interest in acquiring me, why wouldn't I just automatically pick up the phone and, hey, Villi, you know, we've got something interesting going on. Why do I need a contract?
Most of the time they will. Most of the time they will. And I remember, what's his name at Sequoia, the WhatsApp partner, Jim Gatz, give me the exact same strong argument when I was, we were making an investment in HubSpot. But you get in the emotion of the deal, you get a very attractive offer. Why screw it up by start calling around, right? Why bother? It's a great freaking offer. Let's just take it. And you get into the dynamics of the deal, and you don't make the call. And one of their portfolio companies, which we may have been interested in, I said, well, Jim, did you call us on that one? It's a company that IBM ended up acquiring, and he said, yeah, of course I did. I said, why don't you check on that and get back to me? And no, they did not call us. So most of the time, 98% of the time, we're going to get the call, especially for a company we've made an investment in. But things fall through the cracks, and that notification right is intended to protect you from that 2% of the time that, for whatever reason, they may decide not to call you, or the board decides to encourage them not to call you.
And Gary, from your perspective, because ultimately this is all part of the process, just put some boxes around how the process has to be run, notification periods and the like. How do you help a company manage the kind of nuance between, you probably have an NDA with the prospective buyer who comes with an offer first. You've got this incentive that it's a great deal and everybody wants to get it done. How do you manage the tension there? Because this is what we see. This is probably the most important sort of specific deal term issue that we run into.
Yeah, I would say make sure your banker's a good strategist, because this really goes into your process strategy and how you manage it. In my experience, usually you're looking for a time period when you're going to maximize the effect of that phone call, and that can vary pretty dramatically. I mean, if you are charging down the road on a pretty attractive first offer, then you're going to want to do it and kind of get it out of the way. The other consideration that comes up frequently is you know, shockingly, there's a lot of good feelings around LOI stage, and everybody hates each other by the time you close the deal. If it's well negotiated, or, you know, very difficultly negotiated. Depending on how they're written, you can use it as a forcing function for your existing party to stop screwing around and get the deal closed. There's a little bit of deal insurance. Those are probably the two most common.
You'll notice that we do not actually have to put anybody between Ron and Aaron.
So Aaron can kick me in case I go off script. So.
Well,
I'm a Yahoo employee, and I honor that.
But let me ask you, for each of you, is there something that you wish you had done differently in that deal, or any deal, just kind of generically?
So look, I oftentimes tell my team, like, point to a deal that went perfectly, right? Like, point to it, right? Point to an integration that went perfectly. Go ahead, I dare you, right? So, and I have a strong belief that sort of that intelligent minds and goodwill sort of get over most all things that need to be gotten over. And so with that, like, we're regimented about like. About sort of lessons learned after the fact, right? Like, we're kind of waiting for things to settle for BrightRoll, but that will happen. Like, Todd and Ron and all of his team will sit down with me and my team, and we will debrief them as to what happened. We haven't done it yet, we're going to. There's always, I don't want to get into sort of the sausage making, but suffice it to say, there are always things that sort of we wish hadn't happened. In particular, I mean, if I do get into the sausage making, BrightRoll timing slipped, right? Like, we were on target for something, and then it slipped, and it was an extraneous factor. It wasn't anything that the BrightRoll team had done. It wasn't anything that my team had done. It was simply an extraneous factor, and I wish that we had sort of better communicated that, controlled the process around that, because it added tension that was, in hindsight, probably unnecessary.
I think, from my perspective, as the CFO or general counsel or the CEO or the board, you get very focused on the deal and definitive, and you think a lot about that. Luckily, we had hired a SVP of people, head of HR, about a year ago, and she really made us focus on a lot of the personnel issues that can easily get lost in the shuffle. We had almost 450 employees at the time of the acquisition. You want a successful acquisition, those people have to be happy with not just the deal price, but they have to be happy as they integrate. And that's as much your responsibility at the target as it is at the acquirer. And no matter how much time you spend on that, there are obviously constraints. And you have to build in, I think what we didn't get perfect in the deal, we tried to get right very quickly after. Because there's just a lot of factors you just don't even think about, right? Like, we got really stressed out about 280G. Like, oh my God, everyone's gonna find out about how much people are making. For those that aren't familiar with 280G, it basically like lays out for, a large percentage of your management team, various criteria. It's pretty technical, but how much they got in the deal. And for options and potentially RSUs and any bonuses, et cetera. We got really stressed out about that because we were like, everyone's gonna know. Not a peep.
And I'll jump in for a second. If you don't do that disclosure, there's a huge tax on the recipient of...
Well, the first question everyone has is, oh, we have to do this, and then you get over it. But you spend a lot of time thinking about that. And we spent a tremendous amount of weekends and nights, because you had to do it when the other employees aren't around, in conference rooms or offsite at your council or your bankers, kind of going through person by person. What is their comp structure? What is their RSU grant? What is their title? What is, and working with the Yahoo team. And that becomes a very big piece kind of post-announcement. A lot of people just, everyone gets so, lawyers have a million things to do between signing and closing, but you buckle down your HR department, because some of them just found out about the deal. Deal gets announced on Tuesday morning, Tuesday afternoon after market close, and then all of a sudden there's 1,000 questions. Their whole HR department, except for the head, doesn't even know about the deal, right? So we spent a lot of time preparing, and if I wish I had slept less, it was probably around those type of issues instead of the deal issues that you spend a lot of time negotiating on the back. So as just an employee of a company, I would spend a lot of time thinking about that.
And having put, oh, sorry, go ahead.
Yeah, that's exactly right. One of the, on every deal, I wish I had done something different. On every deal, I make mistakes. And I kick myself later for not thinking about something. So, and I do this for a living. So, the reason it's the Wild West is there's so many things that go into it. Some of them, so many of them are not deal related. Specifically, as was just mentioned, the employee issues are huge. Like the tendency is always to undertitle and underpay incoming employees. And I've made that mistake. If you ask the founder of any company, do they care what the title is, what their title is in your organization, they're going to say, I don't care. And they don't know that they do care, and they should care, and they will care. And so making sure that you're thinking about all these soft issues, setting these people for success is key for making an acquisition successful, and that's not about the deal. That's just purely understanding kind of human nature and what motivates people and how to do the right thing. And it's so easy to oversee and not pay attention to that stuff.
And having put Aaron and Villi on the spot, I will say, in our experience when we do a lot of M&A, there are good buyers and bad buyers. There's a high degree of correlation of good buyers being extensively repeat buyers. There are processes, just as Aaron mentioned, and they go through debriefs and figure out what could have gone better. They learn from, good organizations learn from that. And one of the things, it sounds silly when you say it, but it's incredibly important. One of the key elements for success of a deal and integration of a team is the significant other of the employee, engineer, whoever it is, understanding what their benefits are going to be. Can they go to their doctor after the company is acquired, or do they have to change doctors? It's so little in the grand scheme of things of the deal, but it's so critical. And what you'll find is the big companies that do a lot of deals understand those little things because they've integrated so many teams into the organization. So I'll make that pitch on behalf of companies like Box and Yahoo, who do a lot of deals. They just do those little things better than anybody else. I want to get to Q&A, so I'll kind of close with one of the questions that the audience asked. And it ties to what you said right up front. Are we in a bubble? If we're not in a bubble, how do you know? And what will you say in retrospect were the signs that, oh, well, maybe we were in a bubble? At what point does this turn into a bubble?
Yes, I'm happy to take the first crack at that. We don't know, but it sure is fun to talk about. Now, I think from our perspective, a bubble goes deep into a market. There's a lot of irrationality. The valuations well through all of M&A get extreme, and we don't see that at all. I mean, the level of very, very significant strategic value transactions is actually pretty thin. And what happens is the media focuses on all the highlight cases, and while it is the Wild West, the rest of the M&A market, it just kind of churns along and does its thing. So, there aren't 57, $20 million revenue companies selling for $500 million this quarter. Yep, that's the kind of thing that's not happening. Buyers are, at the end of the day, pretty rational. There are fewer of them than there have kind of ever been in tech M&A. So that means it's a little harder, fewer chairs for people to end up in. So does that mean things at the high end of the market maybe come off where they are? Yeah, I mean, eventually. I think I saw an interesting stat that there's more billion-dollar valued private companies right now than have ever been billion-dollar exits. You know, so that kind of thing has to rationalize itself, but I wouldn't necessarily call that a bubble in and of itself.
Each of you guys.
Yeah, I think about it from a pretty tactical perspective, as just given my role. You know, we're in an environment, 4 years ago, you could have hired an engineer to start up for under 50 grand. I'm a relatively senior engineer. You can find real estate in San Francisco 4 years ago for $25 a square foot. You're scrappy. You know, you just think about your whole cost structure as a startup. And then you think about now, the environment for hiring engineers, you're close to double that if you look kind of full total compensation. Real estate, 60, 70 bucks a square foot, you gotta sign 7 to 10 year leases, like the whole cost structure is. And that drives, you know, that's driven obviously by a lot of capital coming into space, it's driven by a lot of expectations there, a lot of the fundraising has increased in the amount, you know, the Series C versus Series D, you know, I remember with an early stage company recently, because, you know, I'm job hunting, and it was, you know, they were an early stage company, they were raising $35, $40 million, and they were back where BrightRoll was, they were even close to where we were 4 years ago, right? And we raised 20 back then, right? So it's just, there are some dynamics that are gonna create difficulties in the future for a lot of these companies that I'm not 100% sure they've all thought through. And it's kind of, well, what else can you do is gonna be the attitude. So I think about it much more from, you know, you need to be careful, because a lot of these things are priced pretty much for perfection. And that's gonna create problems down the road for VCs. It's gonna create a great market, I think, for corporate development departments. You know, and so, you know, as just an active participant in that market, I think it's really important for people to be just cognizant of that. You know, that a lot of the rules have definitely changed, and as you're looking at companies, there won't be 5 leaders in a lot of these spaces that a lot of money is flowing into. There's going to be one. You need to take a look at, you know, and a lot of the things that are getting a lot of hype. There are a lot of Me Too companies, you know, which to me is a sign, and those Me Too companies are getting very high valuations as well. When, you know, the reality is that there's a very steep fall off within each individual space in tech between the leader, the number 2, number 3, and everybody else, right? And so, you know, in those dynamics, I think that we are. I completely agree that there is a long tail here. There are a lot of companies that are out there just banging away and not participating. So if you think about broad baseball, no. But if you think about starting a company right now in Silicon Valley or working at a startup right now in Silicon Valley, the dynamics are very, very difficult, because, you know, you have a half dozen, a dozen, 2 dozen unicorns out there that are really upsetting the apple cart as far as expectations for engineering compensation, for real estate, for all these dynamics that make it very, you know, very challenging, I think, down the road for a lot of these companies that will end up potentially, you know, looking for exits that, you know, all these companies are not going public, not even close. And so, you know, I think people need to be cognizant of that and just very realistic about that.
I think last week, for the first time in a very long time, I saw a company that has $10 million of revenue, not burning too much cash, and the VCs are willing and happy to take a bath on, meaning they're willing to sell it for less than the $40 million that the company has raised.
How old the company was it, broadly, you know?
How old?
Yeah.
It was probably 5-6 years old company. So I don't think we're in a bubble. Certainly I don't think, to the extent there's some sort of a correction, it will be broadly felt. But I do think a lot of companies have gotten overcapitalized, and I think there's going to be some pain for the venture community in the next few years. And the other most fascinating dynamic that I'd love to see how it plays out in the next couple of years is going to be, there are so many companies that have raised multiple hundreds of millions of dollars, private companies, and they're not acquirable. So they're pedal to the metal, and They hope the IPO market is going to be there, and it's going to be really fascinating to see how that plays out, because we haven't seen that in a while, and it's going to be very interesting. Again, I don't think it's going to be broad-based pain. I do think in certain, mostly in the venture community, that they're going to, some firms may see some pain.
Sure, so I'll comment on kind of this long tail again, earlier stage companies. And it's kind of coming from two directions. One is you have massive overfunding, not only in the multi-$100 million rounds, but all of a sudden, you have everyone's an angel investor. AngelList has made everyone an angel investor. Crowdfunding, everybody's a VC now. And so, savings accounts or 401ks are now going into tech companies, and so you get all these entrepreneurs and all these companies. So that's one dynamic. You have portfolios with 500, 600, 700, 900 companies in it. So that's one piece, and those venture firms are trying to figure out how do they continue to get liquidity and move on to their next funds and continue growing in their own life stage. And so for that reason, we see a lot of large portfolios be interested in just getting some sort of liquidity out of a very, very, very illiquid market, which is the super long tail and earlier stage. So that's one piece. There's more interest to be selling earlier on. On the buy side, not only are there incredibly acquisitive companies here in Silicon Valley, but you start to see very acquisitive companies outside of Silicon Valley. And so Under Armour yesterday was buying two companies for $600 million, $575 million. Chobani, the yogurt company, opened a tech incubator in New York a few months ago. ESPN, TV company, now all of a sudden, if you've looked at their apps over the past year, have completely rebranded or remodeled them. They brought a bunch of Silicon Valley talent out there. JP Morgan, Jamie Dimon says he's hiring top Silicon Valley execs to come over to JP Morgan. So not only are there heavily funded tech companies that are overpaying engineers, now you're getting the rest of the world who actually, tech's 15 to 10% of the rest of the kind of world of value that are now starting to compete in the same market. And so that creates a tremendous pull for and demand for talent and expertise. And so I don't think it's a bubble. I think it's actually an expansion, and maybe at the higher ends, I agree. I don't know what's going there. But there's just a tremendous demand across the board. One anecdote, which was crazy, and I hope for our own industry's sake, this doesn't become the norm, but we had a group of 5 data scientists from a company that's very well known for data science come to us and say, hey, we don't like our situation we're in, we're leaving the company, can you sell us to a company as a team of 5 data scientists? And we did, and those guys got an acquisition package, a tremendous acquisition package. They didn't bring any IP, it was just them as a group. And they were competing with all these other big companies. So I don't know. I think a lot's changing. The world continues to be, needing technology to reach end users to be more efficient inside of these large traditional companies. So it's just becoming tremendously more difficult to compete. But then I go back to the startup perspective, and that means there's actually a lot of value for an earlier stage company, their earlier investors, the founders, and everybody to actually realize some gains, in the earlier stages of the companies, which haven't been possible before. Eric?
Excuse me. So, I don't know if there's a bubble or not. It seems a little bit of kind of a reductionist label that the media loves to use. Whenever I face this question, I ask myself, I think of it as, are we seeing genuine innovation, right, or not? And I think we are. I think that there are companies out there, there are teams out there that are innovating in ways in delivering value to users, be them enterprise, be them consumer, be them, in ways that were not achieved before, right? And I leave room in my definition of innovation for technical innovation, stuff that has never been done before. I love that stuff, by the way, right? Like business model innovation, right? Can I dispatch what's effectively a taxi to you and show you where it is and track its progress, et cetera, et cetera. Down to, and product innovation, right? I'm not splitting atoms, but I'm doing a product that's well known and I'm making it better, right? And I think there's a lot of room in there for real innovation. And then honestly though, where I think we have this question is, I think there are people who are not innovating, that are also participating in the market, right? And I love my job because part of my job is to sort of answer that question is this real innovation or not? And is this innovation that I want Yahoo to play a part in? So it's a rough question, but I honestly believe philosophically that there is innovation going on out there, right? I had a chance to, in my prior employer, I bought a company called DNN Research, which was a professor and his students out of the University of Toronto that were doing deep learning, and deep learning is now this big thing. But I kind of philosophically believe that machine learning is moving, doing things that it was not capable of, 5 years ago, 10 years ago. Deep learning's been around for a long time. It's hot now because the machines can now actually do some of the things that were theorized before. I'm not going to tell you what we paid for that company, but I will, there's a great Microsoft research quote where he says, people who are genuinely good at deep learning are making sort of NFL starting quarterback salaries, right? And so, or I think he said NFL quarterback prospect salaries was his exact phrasing. So, but I also wonder whether there's not genuine innovation behind that, and I happen to believe that there are. But I also believe that there are lots of companies where you're like product, no, feature, maybe, kind of a forced feature, not sure I see the genuine need. Do I see any real user adoption that would prove that I'm wrong? No. And I think that those companies are unfortunately getting funded. And you talk to their VCs and you hear things like, well, I should make my money back. And I go, so what part of the capital markets are you participating in? I wasn't aware you were buying T-bills, right? I thought you were doing venture investments seeking outsized returns in exchange for outsized risk. So that's my diatribe, but I would say in short, I do think real innovation is happening, and I think that those companies are being recognized, and I think that that's at the sort of the heart of it. Unfortunately, I also think there's a lot of Me Too's that are not really truly innovating, and they're participating as well, and our job is to tell the difference.
If I can add something to what Jacob said, which I think is Mark Andreessen started with his quote, software is eating the world. And actually, we're starting to see that play out. If you're at Walmart or at Home Depot or at Carrier making, thermostats or air conditioners, what are you thinking? What do you look ahead and what do you see? You see massive disruption in your business, or the transportation industry, the grocery stores. You see massive disruption coming your way, and they wanna play and try to control their destiny. So I think what Jacob said, which is the more traditional industries trying to find how they can build some technology expertise and transform their business around technology. I think that is happening. That will continue to happen in the payment industry. That everybody's opening incubators or some sort. They're trying to figure out. They know they're getting disrupted. They're trying to figure out how they can participate or prevent it from happening. And I think that's going to be a 20, if not 100-year trend. So when we talk about bubble, I have the same reaction. It seems like reduction is a silly question because nothing is going to stop. Nothing, there are macroeconomic things that can happen, but nothing is going to stop this transformation from happening, and that's a very long-term trend that's going to keep technology at the forefront of really every industry.
Questions?
I've been told that patents are not very important during an acquisition. I don't really understand that. Is that true? And if it is true, why?
So you're looking at me, so I'll hazard an answer. I don't know that you'll ever quote me saying that patents are unimportant. I think that it's a very relative thing. I didn't do the deal. I was at Google when they bought Motorola, right? I don't think it's a surprise that was largely driven by patents, per their previous action of spinning off most of that business at this point in time. Yahoo has a different perspective, largely because we have this long legacy in our spaces, and we're reasonably well patented, so that the 2 or 3 or 10 or 20 that a startup might have. We look at it and go, okay, like additive but not formative to sort of value from our perspective, right? So it's a relative thing. It's also a matter of, like, there are lawyers in the room, so they should answer like whether patent reform is needed and all these other things like that. It gets deeply complicated, and I'm not smart enough to talk about it. What I would tell you is I'm not going to discount your patents. I'm not going to, don't care. It depends on what I'm buying you for and what I hope to achieve with the acquisition and the rationale that I've sort of stated to our executives. And if patents are among them or intellectual property is among them, like great. I think we can do a decent job of sort of reflecting that in value. But if it's not, then like that's my rationale for the buyer. And if another buyer might have a different rationale, and patents might be at the core of that. And it's also a matter of position. The Google had made some moves for patents. Yahoo didn't feel the need because we're well patented in our areas of operation.
For a young resource-constrained company, patents are another investment like any other, whether you're hiring engineers or marketing people or patents. It's just one element of how you build the company. They're not valueless, and for the right to the point that for the right company, they can be incredibly valuable. But you have to invest in them, and there's an ongoing cost. And so you weigh it like any other economic decision you make.
You're talking about some of the soft things that are hard to deal with for integration. As you look at an acquisition target, or even you look at a buyer, how much do you guys look at culture and whether or not culture is enough to squash a deal that maybe financially makes a lot of sense, but could lose the people, things can happen.
I'll flip a coin.
I'm happy to take a crack at that. This is one of the things that's interesting for me over the last 15 years is it's more and more important every year. We've certainly been in a number of situations where there's a pretty dramatic difference in culture, and that will kill an otherwise good deal. The other element of that was discussed earlier was how the compensation packages, the stay bonuses come together. That's the other kind of related trend that has also kind of increased over time. I think everybody, especially here in the Valley, who's done a lot of acquisitions, has figured out, not shockingly, those when the team leaves a year later don't work out as well. So there's a lot of focus around those two issues on a kind of a relative basis.
We did a corporate culture session like this a few months ago, and we had something like 250 people, and there was a surprisingly large percentage of the audience who were from large corporations. These were people for whom their corporate culture was pretty well established, but they were looking at how to fit newcomers in, whether it's by organic growth or acquisition, but then also to see how they can leverage that to change their own organization. So we see it as important. Other questions?
I was wondering if you covered, like in M&A, just like venture investments are considered as good successes based on the IRR and so forth. In the M&A scene, like a Tumblr or some other acquisition, what is the measure of success for you, saying that this was indeed a great acquisition for us? Sure.
So, we work hard to be as disciplined about that outcome as possible. We don't have the advantage of a venture fund sort of making a discrete sort of cash outflow and then hopefully getting a discrete return. So that I wish that were the case, but it's simply not the case. What I would also add is what we do is this, right? We work hard when we go to get a deal approved, be it BrightRoll all the way down to a tiny little talent deal, to make, the term I love is sort of verifiably false statements about strategic rationale. What I mean is I want to be able to go back and it not be so like loose or vague that I can't tell whether we actually achieved it. So we try to make verifiably false or true statements as to what we're going to do with that acquisition. And that has everything to do with just simply team, technology and how it will be implemented, product launches that they will augment or add, all the way to, in the case of a BrightRoll, all the way through to sort of financial results, right? It also, the other thing to mention is, it's almost, especially Tumblr is interesting because we're running it very, very separately, and then it's a pull integration model where they go, okay, look, I'd like your help on search. Great, we can help you on search. But most of the time, you're coming into an existing unit that has value, and as the integration moves on, I can no longer tell the difference between the acquired company and the unit that they got into. So it's hard for me to really document in a dollars and cents way that return. We do our best from a financial model to sort of look back every time. How did we do versus the financial model, and be disciplined about that. But do I have like a hurdle rate, much like a VC might have? No, of course I don't. We measure success as strictly as we can, but we don't have some of the advantages that they do.
Hi. In an acqui-hire situation, what is the minimum size of team you're looking for? I mean, is it that, okay, if it is less than 5, don't even worry, it's too much for trouble to go through, for just 5 people or something like that?
Well, so what we've seen is, at my smallest 2, depends on who's the company that's buying. If it's there's a lot of companies right now who've raised $100 million and they need to be growing their teams by 200 people over the next 12 months. So they're looking at it's chunks as small as 2. Those deals are pretty standard type deals. They kind of just work through the recruiting organization more than the corp dev organization. But that's kind of as small as 2, as large as 15, 20, depending on what the appetite for the company is.
As small as 1, as large as 150. I don't know if you were Google when they did Slide, but that was mostly a talent deal, and they were duking it out with Facebook and social. So there's most of them by nature are teams that have raised $1 million, have tried a concept, didn't work out, and they're looking to land somewhere. So most of them naturally gravitate to the 3 to 8 people, but it could be all over the place. Obviously, the company I referenced earlier, which is $10 million revenue looking to sell for less than the amount of capital raised, they'll end up being a talent deal for somebody with 40, 50 engineers.
Have you seen any increase or decrease in the range of acquisitions being done without having to go to the board, like a general manager of a business unit?
On the buyer side, approval levels?
Go ahead.
In our experience, it totally depends upon the company, and it depends upon the size of the deal. If you're doing a 5-person acqui-hire, and if it's a good-sized public company buyer, that's usually at the business unit level or somewhere around there. As the size of the deal gets bigger, then ultimately you've got to go to the board. It really depends, and it depends upon where, what country. U.S. companies are different from Asian companies or European companies, so there's a huge range.
Every company has some sort of a policy. The policies are just all over the place depending on all the factors that were just mentioned.
As an enterprise SaaS company, we've seen most of the general managers we've talked to is 50 million is their max. Anything over that, they have to go to the board.
All right, it seems high. At Salesforce, our threshold was much lower. So
yeah,
and at Box, it's 0.
So I would say, I won't speak for every sort of large serial technology acquirer, but at Yahoo for sure, every transaction, no matter how big or how small, runs through an executive review, right? There is no, I mentioned before, so I'll use them again, like Jeff Bonfort can't do a deal without me. Like, sorry, I know he would love to, but, and that's not to make myself indispensable. I'm just, there's a proper process and a review process, and for us, it means a check-in with our executives. We feel strongly about that. Acquisitions should be made. Obviously that general manager, that product lead is what I would call, is sort of front and center for that review, but it goes through executive review, certainly.
And by the way, to Gary's point about high touch, the answer to that question is exactly the sort of question that you're asking from an experienced banker who, before you get into the organization, knows exactly where the approval levels are for the size of deal that you're likely to do. And last question?
Question for the ones that call like Yahoo and Box. What level of size is like our earnings impact important for your executive views and what level not? Super size companies obviously. What level of earnings impact or accretion dilution or the strategic nature of the acquisition makes sense? I mean, at what level of earnings impact is it sort of like your execs are not willing to go to for a strategic acquisition?
I'm neither one of their counsels, but I would tell them not to answer that question specifically.
I think the more interesting question actually is, and I hear that all the time, a company, you want to acquire a company, first of all, if the company is only at a $5 million, in $5 million annual negative territory, once you acquire them, that turns into 10 or 15 because big acquirers or bigger companies tend to pay better, they have better benefits, so you change the cost structure very quickly. And the second thing, which is rather naive, is to assume that $5 or 10 or $15 million is immaterial to even Yahoo or Google. That's still a material amount because it still impacts somebody's budget, right? So that person is not going to be able to hire 100 engineers because they did that deal. So you can't just blow your budget because you did an acquisition. So even seemingly small acquisitions tend to have very large impacts on Bomford's budget or on divisional leads and their budget. So don't assume that your small company is not impactful to that individual. We go through a lot of pain to manage those impacts and navigate through it, but it's always a political and challenging conversation on the other side.
This is very tightly related to the question about approval thresholds. If you could please join me in thanking the panel. It was a great panel. And if you were invited to this by somebody else and you